Ladies and gentlemen, thank you for being here today. In the ever-evolving landscape of global finance, we find ourselves once again witnessing an unexpected twist. Bitcoin, the world's leading cryptocurrency, has recently experienced a notable price sell-off, just as traditional stock markets rally in response to the latest US-China trade developments announced by former President Trump. Now, why would Bitcoin, often dubbed digital gold, take a downward turn at the very moment confidence returns to equity markets? To understand this shift, we must look beyond price charts and headlines and examine the broader economic and psychological dynamics at play. Over the last 30 days, Bitcoin has enjoyed a substantial 24% gain. That's an impressive rise by any measure. During the same period, the S&P 500 futures increased by 7%, while gold remained largely flat. Traditionally, such divergence could hint at Bitcoin's unique position as a hedge or alternative investment. But what we're seeing now is a shift. Investors are reevaluating Bitcoin's role as correlations between it and traditional markets rise. Today, that correlation stands at a striking 83%. In simple terms, Bitcoin is no longer moving in isolation. It's moving with the crowd. Adding to this context is Bitcoin's extraordinary rise in global relevance. It has now surpassed the market capitalization of both silver and Google, making it the sixth largest tradable asset on the planet. This milestone reinforces Bitcoin's legitimacy as a major financial instrument, but also brings with it higher scrutiny and greater interdependence with global market forces. Meanwhile, another important player enters the stage: the US dollar. Historically, gold, Bitcoin's spiritual predecessor in the world of scarce assets, has had an inverse relationship with the US dollar index. On May 12th, the dollar hit its highest level in 30 days. This strength suggests investor confidence in the American economy, despite a minor 0.3% decline in the first quarter GDP and a surprising 6.1% surge in pending home sales in March. What does this mean? It tells us that risk appetite is returning to traditional markets. Investors are more willing to bet on companies benefiting from improved trade conditions and lower tariffs. This brings us to the psychology of market participants. When Bitcoin hovered near the $105,000 mark, many investors hesitated. The reason? Reduced urgency to hold a scarce asset when stocks, viewed as more directly benefiting from the US-China trade deal, became more attractive. Lower import duties signal higher company revenues and stronger margins. Investors, always hunting for short-term advantage, have temporarily turned their gaze. Yet all is not gloomy for Bitcoin. From May 1st to May 9th, US spot Bitcoin ETFs, exchange-traded funds that allow investors to gain exposure to Bitcoin without directly buying it, saw $2 billion in inflows. This level of demand, especially after such a strong monthly price rally, suggests that institutions, not just individual traders, are leading the charge. Why is this significant? Institutional investors tend to think long-term. They are less swayed by daily headlines and more focused on strategic allocation. This kind of adoption signals a deepening maturity in the Bitcoin market. It also reassures us that, while short-term price volatility is inevitable, the long-term trajectory remains promising. In conclusion, the recent Bitcoin sell-off is not a sign of weakness, but a reflection of broader economic shifts. As traditional markets rally on optimism about trade and growth, Bitcoin is simply recalibrating its role. The data shows a resilient, maturing asset supported by serious capital. As observers, analysts, and participants in this financial revolution, we should focus not on the day-to-day fluctuations, but on the fundamental trends shaping the future. Thank you.